Good afternoon, everyone. Welcome to this wonderful webinar on transactions in immovable property and joint development agreement, taxation aspects, organized by Direct Tax Committee of ICI. I am CA Ritu Agarwal and I'll be your host for this session. We are glad you are joining us today to explore the taxation nuance of immovable property transactions and the joint development agreement. Get ready to gain expert insights and take your professional growth to the next level. So, first of all, let us set the tone with the welcome address by CA Piyush Chajed sir, Chairman of Direct Tax Committee. CA Piyush Chajed sir brings 25 years of extensive expertise as a senior partner of Messrs. Chajed Doshi and Chartered Accountants, a distinguished chartered accountancy firm located in Mumbai. His educational background boasts bachelor degree in commerce from NM College, Mumbai. He holds a diploma in information system audit. The rich educational foundation has equipped him with the knowledge and expertise to excel in the integrate realm of financial and taxation aspects. Notably, Sir was a member of Central Council is was a member of Central Council of ICI from 22 to 25 and for second term for 25 to 29. He is currently technical advisor on International Auditing and Assurance Standard Board and member of committee to study fiscal regimes, other statutory requirements of business in SAARC countries of South Asian Federation of the Accountants, SAFA. Sir is on board of Wimplast Limited, Saloword, and Multibase Limited. In addition, his contribution extends to RBI, where he held a key role as a member of External Advisory Committee for ARC. Sir, with this, over to you. We are eager for your insights.
Thank you very much, Rituji, for your introduction. Who is a managing committee member also from Vasai branch. My vice chairman, C. Vishnu Agarwal, whose leadership Direct Tax Committee is doing wonders, I would say. He has been a great support to me as a chairman Direct Tax Committee. Thank you, Vishnu Bhai. C. Manoj Gupta, the speaker for day, who has chosen a very important topic, I believe, transactions of immovable property NJD. I think so. A lot of issues are there. And I'm sure in today's 2 hours session, I'm sure you will be able to clarify a lot of doubts. I'm sure a lot of questions will be coming to you. I'm sure Ritu will be putting before to you, and you will be tried to able to solve those queries, questions, answer to the best of your ability. My request to you. Obviously, as a chairman of Direct Tax Committee, I thought I'll just brief you on 3 or 4 important things which are under development. Last week, in fact, we have already given our pre-budget suggestions, and we had our 2 hours meeting with the chairman, Central Board of Direct Taxes, and all the members from TPL were present. We gave presented in our PPT more than 60 suggestions to them, and it was a very great meeting. Wherein chairman also expressed that we should have more frequently this quarterly meetings, which was also envisaged, in fact, last year also, but it could not take up well. And again, chairman proposed that let us have a more quarterly meetings wherein we can discuss whatever issues the SSCs are facing, the profession is facing, the facilitators, the tax professionals are facing. And 3 important areas which have been suggested and discussed during the pre-budget, apart from our suggestions on the tax policies, whether we can have a joint FAQs for the various issues which come under the Income Tax Act. And if the joint FAQs are issued, whereby, like, of course, circulars and guidances are being issued by the CBDT. But if FAQs for a particular, let's take an example, a section on TDS, if institute can and CBDT can join hands, then obviously if institute is stating something and is accepting the FAQs, then obviously the membership across and tax professions across will follow that, and it will have a weightage over the judicial fora also. So that was the one of the tone which we had thought, and maybe in next 2 weeks or 3 weeks, but the office will start working on that and will select 2 or 3 topics and try to make some FAQs on those particular sections, and then start the discussion with CBDT. If that comes through, I think so it would be one of the good development for the profession as a whole per se, whereby jointly if some FAQs are issued, I'm sure any chartered accountant who is acting as a tax professional or a tax auditor would have to follow that. or will follow that, and therefore the litigation should come down. So that was the one important area I thought. Of course, as far as pre-budget suggestions are concerned, a lot of suggestions are given. We had already given our clause by clause suggestions during the making of Income Tax Act when it was not yet became an act; it was a bill. But important suggestions were again given to them, which are available on our website also. I'm not going into those suggestions, but importantly, we have kept in mind ease of doing business also. We have also kept in mind further simplifying the law to that extent. Also, a lot of suggestions have happened on 44AB, revisions of 44AB also. Apart from that, there is another two areas wherein Direct Tax Committee is currently working. Committee has been formed by the CBTT for revision of ITR. For that, we had also circulated Google Forms among the members, and we have received certain suggestions. They are almost under finalization, and there are two ways of revision which are happening. One is income tax returns to be forms from ITR 1 to 7 to be revised for the assessment year 26-27, and also devising new forms for Income Tax Act 2025, which will be applicable for financial year, which we say tax year 26-27. So we have already finalized our suggestions by today evening. Latest by today evening, our suggestion should go to that particular committee also. Apart from ITR, because the suggestions were sought on complete revision in Form 3CD, 3CA, all the forms. So another suggestion is going on revision in Form 3CD also, which has already gone, and Form 3CA and 3CB, that is our audit report. We have tried to make a suggestion that whereby this audit report can be brought in line with SS 700 issued by the Institute of Chartered Accountants, wherein in the Form 3CA and 3CB itself, you can define the auditor's responsibility, management responsibility, what is the important areas where I am responsible and where the management is responsible. More importantly, as you all know, in 3CD, we are certifying true and correct. We have suggested that because we give an opinion on financial statements where we certify true and fair. Technically, even the Form 3CD could be true and fair rather than true and correct. Let's see what happens. Those suggestions have already gone. So I thought these two or three important developments. Last, but as we have discussed earlier also in this such forums, on ease of doing business, government is very keen on making changes in tax policies with bringing in ease of doing business. The last ranking which India got was in 2022, from where we actually traveled from 123 rank to 63 or 64, which I believe was stopped. That ranking was stopped by World Bank, but now in 2026 that is happening. So we, as an institute, as a direct tax committee, we are part of the joint working group formed by the Ministry of Revenue for improving the ease of doing business. And a lot of places we are supporting the authorities of Ministry of Revenue, whereby we are giving them a 30 minutes platform where they are able to address our members, they are able to address general public, and actually share their experiences in this regard. So ease of doing business includes how the tax policies can be changed, how circulars, guidance note can be issued, how litigations can be brought down, what should be changes in ITR forms. So these 3 or 4 areas we are working jointly with them, and every branch in fact has been supporting, and the 30-minute slots have been provided to them. Of course, for the government, as we know today, ease of doing business has become a buzzword. They are trying to make an effort in all laws everywhere they can make. Income Tax Act is the one of the major important criteria, because tax policy is a major important ranking criteria by World Bank for improving ease of doing business. And obviously, this government wants that from 64 I should travel much higher today, which will actually boost investments in India. So I thought those 3 or 4 important areas. I've come back, I think so, almost last 2-3 weeks we were not able to do the such sessions because of tax audit pressures which our professional members were facing, and we thought it appropriate, let us not disturb the members, because there won't be an educate audience also, because we can understand that when you are busy with your tax audit season, it's very important. But now you have a comfort level, it's time. Generally, December, Jan, and Feb, these are the 3 months when it's time to continuously upgrade yourself, get equipped to it. Once the season is over after 10th and November, I and Vice Chairman will be discussing, and we'll also try to take now more in-depth topics on Income Tax Act 2025 also. Once the application is over, or maybe after 10th of December, when no more this act, of course, it would be relevant for one another assessment year also, but it would be important to also now discuss on Income Tax Act also. So we'll also try to structure the sessions on that. So with this, thank you very much. Very good evening. Very good learning to all the members. Thank you very much. Over to you, Ritu.
Thank you so much, sir, for this wonderful insight. Following the welcome address, We will hear opening remarks from CA Vishnu Kumar Agarwal sir, Vice Chairman of Direct Tax Committee ICI.
Thank you,
Please,
Ritu.
Vishnu. Sir,
Correct. Yeah,
introduction.
we will give more time to Manoj.
Okay.
So thank you, Rituji,
Thank
for opening remarks. Our Honorable Chairman of the Direct Tax Committee, CA Piyush Chhajer ji, very learned speaker, Manoj Gupta ji, and my sister Ritu Agarwal ji, today is moderating this session. Friends, first giving my opening remarks, first I appreciate that Manoj Gupta ji has given so many inputs, so many times for the Direct Tax Committee for revising our guidance note 44AB. When I was discussing each section by section, clause by clause, Manoj Gupta ji was the first person to give input for each and every point, each and every clause. So thank you, Manoj ji. In fact, I have not interacted more with you, but when the first time I was discussing the revised guidance note, that time I was thinking that if Manoj Gupta ji is not, if not available in the group, so how we will conclude the our guidance note. So thank you very much, sir, for giving your valuable input in the guidance note 44AB. Friends, our chairman has already described about the direct tax committee, what we are doing. Friends, first time we have came out with the Direct Tax Income Tax Act 2025, and I request each one of you, it is available for the sale in rupees only 500. As a direct tax committee, we have thought that all the publication house, they are selling in 2000, 2500 rupees and 3000 rupees. So why we should not print this in Direct Tax Income Tax Act 2025? So the tabular mapping with the old provision and new provision, we have mapping the as a tabular form. So very good act for each and every chartered accountant. So I request each one of you take the maximum benefit for our Income Tax Act. Friends, we are again working hand to hand with the CBDT, giving various suggestions to the CBDT. Friends, I request each one of you, if you have any idea, input, suggestion in your mind, which we should present before the CBDT and the revenue, friends, you send email on the direct tax dtc@the rate of ici.in. Your suggestion, inputs are most important for our representation before the CBDT. Friends, I will not take much of the time because today we have the learned speaker Manoj Gupta ji on the transaction of the immovable transaction properties. So it is very important topic for each and every chartered accountant, because in day-to-day activity so many difficulties we face. Friends, it the before the CBDT and the finance ministry, as a Direct Tax Committee and the Institute of Chartered Accountant of India, we are presenting several representation before them, and they are also considering as a very uh, positive moment, and they are also considering each and every point, each and every close by close suggestion, whatever we are giving to them, they are accepting us. And in before 15 days meeting with the CBDT chairman also, and he has said that every quarterly we will do the meeting with the Direct Tax Committee and take your opinions, suggestions. So friend, it is very good move from the Institute of Chartered Accountant of India as well as the CBDT. With these words, I thanks to each one of you for participating in this webinar, and especially thanks to my sister Ritu Agarwal ji and Manoj Gupta ji for this webinar. Thank you, friends.
Thank you so much, sir, for the wonderful words. Uh, Now it's time to listen our speaker, sir. Before that, I would like to take the privilege of introducing our learned speaker, CA Manoj Gupta, sir. Sir has qualified in year 1996 and is in practice. Currently, he is serving as a special invitee to Direct Tax Committee of ICI. He has a flair for reading and writing, and he has to his credit many articles on issues under direct tax and GST. He contributes write-ups and GST and income tax relatable matter on WhatsApp groups, which were well received and uploaded. He is analyzing the finance bill since 1996, and since Act 1996 till recently enacted Finance Act 2025. He has analyzed and commented upon each single bill. He is an active speaker on various fora and delivers lectures on income tax issues very often. Sir has authored many books on topic relating to direct tax, among which recent one includes Direct Tax Ready Reckoner 2023, Handling Tax Audits, Capital Gain Taxation, Income Tax Practice, and Handling Various Notices and Tax Planning under Income Tax Act. With this, I request Sir to please take the charge. Sir, your mic is off, I guess.
Thank you, Moderator Ritu Agrawal ji, Chairman Direct Tax Committee Piyush Tajir sir, Vice Chairman Vishnu Agrawal sir. Thanks for recognizing my little contribution in the preparation of guidance note on tax audit and appraising me, and all the members who have on board today, uh, devoting their valuable time for this webinar. Today we have taken immovable properties transactions and JDA. Look, most likely JDA will be left because of the paucity of the time. So if committee permits, we will do a webinar on JDA someday else. If possible, we will do it today itself, no problem. It depends upon the pace with which we can go, because 45.4 will take some time. The next year is going to be very busy year for the professionals, and we have to struggle with two acts at the same time. One is the old Income Tax Act, and another is the new act with which is coming. So we have to devote more time to direct taxes, and I have already started studying new direct tax act, and I have shared some of the presentations on it. So for the benefit of members, even if there is no seminar webinar, I share presentation on a regular basis. In the last 2 months, I was suffering from some serious health issues, so better stop. Now it will again start. Hopefully, the God will be kind to us. And I will share entire Income Tax Act slowly and gradually till March with you, with my remarks on differences and the similarities between the both the acts. And then after, we are waiting for rules also, so that we can give a comprehensive understanding of the new act to our members, to my fellow brothers. With this, we open the webinar,
Yeah.
and first part is on transactions in
I
immovable
just
property.
wanted to ask that we will take questions at the end or during the session.
I am comfortable both ways, no problem.
Sir, as you say, usually we keep in last only. So,
Okay, then last. No problem.
thank you.
First part is immovable properties, and second part is JDA, LDA. Immovable properties, we have certain issues, important preliminaries, date of acquisition, period of holding, special provisions, 45, 2, 3, 4, 5. 5A is the JDA part, and 46, 50C, then 54, 54B, 54EC, etc. FSI redevelopment, both are part of the JDA. TDS 194IA, transfer of immovable property, and 194LA, transfer of agricultural land. Another confusing area, computation of capital gains under the new regime. Many members still asking that we have two options, why we can go for indexation and we can go for not for indexation. Sorry, we cannot go for indexation. We will discuss this. Rebates and reliefs, they have now taken that benefit 87A is amended, and 115BAC is also amended. So we start with important preliminaries. Number of First thing is that immovable property is when long term it is, if it is held by 24 months, more than for 24 months. The word used is immovable property, not the land or building. So any immovable property is covered here, and the period of holding will be 24 months. If less, it is short term. If more, it is long term. If you have acquired the property from a previous owner under will, inheritance, or any other document, then period for which the previous owner held the asset will be added to it. And if that previous owner also acquired the asset in similar mode, then period for which last person who acquired the property by any mode other than the specified mode under section 49(1) will inheritance etc. will be the last previous owner, and at that from that period cost will be added, and from that period holding will be added. Number two is important as well as transfer. Transfer encompasses all the transactions: sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of capital into stock and trade by the assessee himself, allowing part possession of the property. Here, one important change has taken place under the general law. Under Section 53A, certain condition is to be met. Earlier, there was a line that the agreement may or may not be registered. Now, that line has been omitted, and Registration Act Section 17(1)A has been amended. Now, it is provided that 53A agreement shall also be registered. Balbir Singh Mani, Supreme Court, or has also endorsed this view. So now any agreement has to be registered before 53A chips in. If you have an agreement where possession has been given, 53A will not chip in unless under that agreement is registered, that power of attorney, whatever it is, or any transaction by becoming a member of a cooperative society, there is a transfer. Now, issue is sale agreement. What happens in many parts of the North India, particularly in our Rajasthan, etc., people take sale agreement, will, and general power of attorney and do not get the transaction registered because of the stamp duty implications. 8% is there, or 6% in women cases. What is the legal sanctity of sale agreement? Supreme Court in two decisions, Surajland and recently Ramesh Chand versus Suresh, has clearly held that sale agreement has no evidentiary value. It is no pressing value. Once the sale deed is registered, then only you are the legal owner of the property. Then title passes to you. That sale agreement, will, and third GPA will not survive because agreement to sale is just an agreement. It may be revoked anytime. GPA is gone once the GPA giver is gone, and will is challengeable. So these three documents have no evidentiary value, no legs to stand in the eyes of the law. And after analyzing Section 5 of the Transfer of Property Act, Section 54 of the Transfer of Property Act, the Supreme Court in both the cases has clearly came to the conclusion that sale agreement is of no value, and you have to have the sale deed registered. Second, in Balbir Singh Mani, Supreme Court has again said that registration of that document that create rights is also required. So in any situation, registration is the must. Otherwise, you are not the owner of the property. So this you have to take in mind while advising your clients. Number two, suppose I create a mortgage on my property and clear it off. Whether I can get deduction of that amount paid? No, because I am the creator. I have put the property under mortgage. But if my father put the property under mortgage and he dies and I clear the mortgage money, then that will be the cost of acquisition and that will be deducted. Number two, sale by bank of your mortgage property is application of income. Again, it will not be deducted even if the money goes directly to the bank and doesn't come to your coffers. This is perfect Threadman's Mumbai bench of ITAT. Interest as part of cost. What happening was people were claiming interest as a deduction under Section 24B while computing income from house property, and at the same time adding it as part of the cost of the acquisition of immovable property. To stop this practice, Finance Act amended the law, and now interest cannot be part of the cost if it is claimed as a deduction under Section 24B or 80EEA. If there is no deduction under new regime, then you can still claim it as a part of the cost, or the amount over and above that amount deducted there can still be claimed as a part of the cost. In the case of immovable property, while computing capital gains, you have an option of substituting fair market value as in 1/4/2001. Suppose previous owner acquired its property, then you can again substitute, and This is the way in which you can substitute the value 1 for 2001, but that value cannot be more than the stamp duty value of the asset on that date. Right to obtain flat and conveyance is a very valuable right. Tata Consultancy Services, Tata Tele Services, Bombay High Court, and that right can be transferred, and that right can be taxed as short-term or long-term capital gain. Acquisition. So in many cases, builder issues the allotment letter, DDA issues the allotment letter. So the courts have taken a view that date of allotment letter is the date of acquisition, even if I pay the money in installments in the subsequent years. This was the stand taken in many cases, even the CB18 circular number 672 and again in 1986 and 1993, two times. But Delhi High Court has taken a contrary view in Praveen Gupta and second is of Gulshan Malik. They say that allotment letter doesn't create any right and buyer's agreement date is the date of acquisition of the property. So in the Delhi area, you have to go by that buyer's agreement. Otherwise, in all and entire India, you can still take allotment letter as a date of acquisition. Agreement to sale. Some points we have already discussed. The Andhra Pradesh High Court in M. Shyamala Rao case has held that once the agreement is there and you get it registered after 5 years, that the registration date dates back to that 5 years agreement date, and in that situation, that agreement date will be the date of acquisition of the property, provided it is not there in the judgment because at that time it was not there. Now that agreement has also to be registered. Balwir Singh Mani case, Supreme Court case. So, if that agreement is registered and now you are registering the sale deed, you can still claim that date of agreement is my date of acquisition of the immovable property. This is how. Power of attorney. In many cases, the matter went to IT80, where the department has added the money received by the power of attorney holder as a money because they say that where is the original owner? You have taken the power of attorney and you have recovered the money. Agreed, this happens, but that money belongs to that owner. And issue in general law is that it is between me and owner that I pay money or I do not pay the money. But for the department, owner is the original person who issued the power of attorney and he only is liable to capital gains tax. This is a very important practical problem coming to the mind. Suppose in 2004 you have issued a GPA and that GPA is continuously trading in the market, and today 2025 somebody goes for registration. Today's stamp value will be taxed in your hands because you are the owner, you are the issuer of the power of attorney, and the power of attorney holder will say, I am just an agent and you have to bear the tax consequences. So before your client goes to the registration and if he takes advice from you have to say him that first take the tax difference because you have sold the property in 2004. At the time, stamp value might have been 15 lakh rupees. Today it is 1.5 crore. So difference is to be collected as tax, otherwise you will be in a great trouble. Now we come to special consideration. Section 45.2 stock in trade, 45.3 capital contribution, 45.4 very important dissolution reconstitution, 45.5 compulsory acquisition, 46 distribution on liquidation of a company which is happening IBC cases, 50C full value of consideration. Just a minute. Suppose you are holding a land or building and you convert it to a land, convert it to stock in trade. Then fair market value on the date of conversion will be taken as full value of consideration, but tax will be done when stock in trade is finally sold. This is the mandate of section 45, subsection 2. So unless you convert, you are not liable to pay tax. One important issue here came is that somebody brought its land as capital contribution in a firm, and firm recorded it as a stock in trade. Then 45(2) will apply or not? So our score bench of ITIT, Mahendra Bhai Z. Jalvadia clearly said that no, because in your books it is still a capital asset. Firm might have recorded it as a stock in trade. Second is contribution of land into the partnership firm. So amount recorded in the books of the firm is the full value of consideration. Here the controversy arises that whether provisions of section 50C would apply and stamp duty value would have to be substituted for that amount recorded in books of account. Because amount recorded in books of account might be 3 lakh rupees, but stamp value might be 7 lakh rupees. The courts have held, Supreme Court in particular, that when two provisions operate in the same field, the Supreme Court in D.R. Yadav versus R.K. Singh, 7 SCC 112, two operate in the same point, the provision near to will be take front seat. In this case, 45(3) will take front seat, and 45(3) will apply, not 50C will apply. Many ITT benches have held that way, but we have a spinner in Jagdish C. Dabalia. Bombay High Court has said this is not the correct view, and they have said, Carlton Hotel, sorry, they have said that you have to substitute 50C value. Second point in the favor of argument that why substitution will not happen, because 45(3) the transfer does not require registration. So there is no chance for determination of stamp duty value assessed, assessable, or arisable. So that can be still be argued. 45(4) was there. When any dissolution happens, then how capital gains tax will be computed. In Finance Act 2021, the department changed the methodology. They brought in section 9 capital B and substituted section 45 subsection 4. In 9 capital B, it is provided that whenever there is a reconstitution of a firm or a dissolution of a firm, reconstitution means when one or more partner ceases to be a partner, under such circumstances that other partners are continuing. One or more partners are admitted to partnership, under such circumstances the other partners are continuing. And when there is change in profit sharing ratio in some partners on all of them, then there is a reconstitution. So if we on reconstitution or dissolution, the retiring partner takes away some land or capital asset or stock in trade, then that fair value of that stock in trade on the date of receipt or fair value on the date of receipt by of land or building, whatever it is, will be charged to tax under section 9B. Sales minus cost, no indexation will be allowed today. Now we come to 45(4). It says that fair value of the asset taken plus money given minus the capital balance without revaluation will be the chargeable to tax. So there will be double taxation on certain part of it, and that is mandated in the section explanation 2 that it is there. The important thing is there must be either resolution or reconstitution of specified entity for section 9 capital B to apply, and for section 45(4) to apply, there must be reconstitution of the partnership firm. Now, whether the capital gain will be long term or short term, Rule 8AA5 provides the method. It says if the money taxed under section 45(4) is attributed to a block of asset or to a short-term capital asset, then it is a short-term capital gain, otherwise it is a long-term capital gain. This is a formula is given in the section itself, B plus C minus T. The important point is attribution of the money. So how attribution? Why attribution first? Attribution is there because firm has already paid tax on the fair value of the land or building. So at the same time, land remains with the firm. So whenever that firm, because whenever that land is sold, so that amount is reduced from the full value of consideration to avoid double taxation. How attribution is to be made? Where the amount chargeable to tax relatable to any capital asset shall generate goodwill and based on the valuation report as defined section 45(4). The amount capital asset remaining to shall be applied as a proportion increase in the valuation divided by the total increase into the amount attributable. 45(4) amount taxable. Where the aggregate value of money and fair market value of the capital asset to be spent per person is in excess of the balance in capital account does not lead to revaluation of any capital asset, nothing will be attributed. Where the fair market value of the capital asset and capital balance in excess is received by a specified entity, there will not be any attribution in this situation. Just a minute. For the description. A specified entity has to file form number 5C. Here comes the issue. Earlier, such forms were to be furnished and certified by the chartered accountants. Department has taken a special way, and now they have put specified entity itself to the test. Let's illustrate. Suppose there is a firm in which there is a land and the retiring partner takes the land. Fair value of the land as on the date of taking by the partner is 15 lakhs and capital balance is 15 lakhs. In this situation, under section 45(1), capital gains chargeable will be 15 lakhs minus cost or expenses. And under 45(4), 15 lakhs minus 15 lakhs, zero will be taxed because 15 lakhs is the fair value out of which you will deduct capital balance, which is also 15 lakhs, and balance will be zero. Number two, suppose the land value is 65 lakhs, 45(1), same 65 lakhs, you will have to compute capital gain. 45(4), 65 lakhs minus 15 lakhs, 50 lakhs will be the amount chargeable to tax under section 45(4). And third is 10 lakhs. In that case, negative value will appear and nothing will be charged under section 45(4). At the same time, loss will not be liable to carry over. Now, amount taxed under section 45(4) will be attributed to any other capital asset held by the firm. Suppose retiring partner takes only the capital balance, nothing will be chargeable. 45(4) is zero. Agar retiring balance receives any asset other than a capital asset stock in trade, then 45(4) nothing will be taxed because he is taking any other asset, not the capital asset. Suppose you are paying 65 lakhs and 35 lakhs to partner, then 65 plus 35, 100 lakhs minus 15 lakhs is capital balance. 85 lakhs will be the amount liable to tax. Similarly, in PR enterprises, there is a land and before retirement, the land is revalued. So capital balance is 20 lakhs and the revaluation amount is 80 lakhs credited to each account. So in this case, in the case section 9, the same is 945.4 revaluation amount plus capital balance minus capital balance would be the amount liable to tax. Now attribution, because 1,20 lakhs will have to be attributed to the land. So that 120 lakhs will be reduced from the fair market value full value consideration at the time of transfer of the land. So these are the attribution examples we have already taken. Now we come to the compulsory acquisition. Original compensation taxable in the year of receipt, enhanced compensation year of receipt. If there is a downward revision, then you have to file an application under section 116 with the AO, and he will recompute the capital gain. If the enhanced compensation is received by a legal heir, then it will be taxed in his hands. Interest on enhanced compensation, 50%. After 15%, balance is taxable. This is the mandate of section 145B. Read with section 57.4. There is an issue going on that if there is issue first section 1037. If there is an individual HUF and whose asset is compulsorily acquired like agricultural land, urban agriculture land, then compensation amount is exempt from tax even if the compulsory acquisition took place on or before 1/4/2004 and money is received after that date. So urban agricultural land is out, but land must have been used by the SSE for agriculture purposes in 2 years before the date of acquisition, and compulsory acquisition shall be there. Now, compensation awarded in section 96 of the Right to Fair Compensation Act is exempt. Circular number 36/2016 upheld in Suresh Prasad, Patna bench of ITAT. So this has to be taken. Under the old Land Acquisition Act, there was a section 28, and there was interest awarded under the section, and interest awarded under section 34 also. So interest awarded under section 34 is for delay in payment of compensation. So that amount is treated as interest. But interest under section 28 has been taken as part of the consideration in many cases. An exemption is awarded under section 1037. And contrary view is also there, where this interest is taken as 50% after 145B. And so you have to take an informed decision. Distribution of asset. Suppose the company goes into liquidation and asset is distributed, then fair market value on the date of received by the SSE is chargeable to tax, and subsequent सेल में वो fair market value को उसको से reduce कर देंगे. इसमें एग्रीकल्चर लैंड भी आपके हो सकती है, एंड भगवती अम्माल के केस में वो भी चार्जेबल टू टैक्स मानी गई है. Section 50C, full value of consideration. Suppose you transfer a property for 1 crore rupees, stamp value is 1 crore 20 lakh rupees, then 1 crore 20 lakh is deemed as sales consideration. But if stamp value is 1 crore 9 lakh rupees, the 10% levy is there, 1 crore will be taken as full value of consideration. SSE has three choices. Either he can challenge the stamp duty value before the stamp duty officer, or he can say nothing at the stamp duty value, and when it comes to assessment, he may say before assessing officer that valuation has not been correctly done. So assessing officer has to refer the matter to the DVO. If DVO determines the value more than stamp value, then stamp value will be the full value of consideration. If DVO determines the stamp value between stamp value and agreement value, then that value will be taken. Otherwise, the agreement value will be taken. So this is a 50C. Leasehold rights. There is a consistent view that rights in land are not covered by 50C, but recently Bombay High Court has taken a different view, and they say no, legal rights are covered by section 50C. Now come to the charitable trust. Section 11(1)(a) is there. separate code है, तो then it is to be computed as per that section and 50C will not come in between. Now we come to part 2, exemptions, deductions from capital gains. 54 residential house, 54B agricultural lands, 54EC specified bonds, and 54F any asset other than the residential house. If there is any special queries, we can take up now here. Nobody? Okay. Section 54, you sell residential house and you purchase residential house. You must be an individual or achiever. You must purchase new residential house within 1 year before or 2 years after, or construct new house within 3 years after the date of transfer of the original asset. The capital gain, if does not exceed 2 crore rupees, then you can buy two houses. And if the capital gain, if the new cost of new asset is more than 10 crore, then amount above over and above 10 crore will be ignored for the purposes of computation of exemption. The new house must be income chargeable to tax under the income from house property. Issue arises that self-occupied property is not income chargeable to tax. No, it is income chargeable to tax, but annual value is taken as zero as per the mandate of the law, so it is still allowable. So you can purchase one house, construct one house, construct both houses, purchase both houses. Options are there if the capital gain amount does not exceed 2 crore rupees. Period of holding of new asset must be held for a period of 3 years from the date of transfer of the original asset. If it is transferred before, then its cost of acquisition will be taken as nil if cost of the new house was less than the capital gain at the time of original. If their cost of capital asset was more than capital gain, that difference will be the cost of acquisition of the new house. Now, clubbing impact, we have to understand. Suppose you own a house, your wife owns a house, you both sell your houses, you both make a capital gain of 2 crore rupees. Then you can acquire two houses for you and two houses for wife. And after deduction of that value, the amount will be added to your total income. So in that way, you can have four houses at the same time paying taxes on. This is the mandate of Madan Lal Bassi, Chandigarh Tribunal. 54 EC simultaneous deduction. Yes, it is allowable. No problem in it. It is allowable. So suppose Mr. A sells a house for 5 crore in a year and he earns long-term capital gains of 3 crore rupees. He purchased two houses. Not allowed because capital gain amount exceeds rupees 2 crore. But if Mr. A sells his residential house and resultant capital gains 1.98 crore, he can buy three houses, out of which two will be deductible, 1 crore 50 lakh or 1 crore 45 lakh or 150 lakh 45 lakh, whatever is per choice of the assessee. The most beneficial is house A and B. Number two, suppose 11995 crore is the capital gain and 1.45 crore is invested in new house and 50 lakhs in 54 EC bonds. Allowable, the entire amount will be deductible. Suppose 1.75 crore is the capital gain and the cost of new house is 2.5 crore. No issues because the cost, the ban is on capital gain, not on the cost of the new house. So this is the mandate. Utilization of capital gain is the mandated by section 54, not the utilization of net consideration or anything else. Amount of exemption, if cost of new asset is less than the amount of capital gain, then difference will be chargeable. If cost of new asset is more than the amount of capital gain, then nothing will be chargeable. New asset 3 साल तक रखना है, we have already discussed. 10 crore limit we have already discussed. So if you invest 12 crore in purchase of another residence, you will get deduction for 10 crore only. Applicability of limit. Suppose you have two houses, whether 10 crore limit will apply to both the houses or one house? Both the houses. So you will get 10 crore limit for two houses. You transfer first, you get 10 crore limit. You transfer second, you again get a 10 crore limit. Cost of construction will always include cost of land. This is the part of that circular number 667 dated 18/10/1993 also resonates it. Self-occupied house we already discussed. Purchasing a flat is a akin to purchase, construction, not the purchase. Quantum of land supported Jabinus Begum, Bombay, Andhra Pradesh High Court has taken the lead. इसमें belated ITR deduction 54 you can claim, it is allowable. There are several judgments on it, so no issues in that. Construction commenced before transfer, no problem. But construction completed before transfer, then there will be no deduction. Part of a house you can purchase one floor, no problem. But you can purchase share in house property, no problem. Deduction will be allowed. You can purchase house in the installments. You can use a legal representative will also comply with 54. Deduction will be allowed. And similarly, you can use borrowed money. There is no one-to-one correlation that capital gain that you earn has to be invested only. Booking of a flat is akin to construction, not purchase. Deposit in CGS. If money is still not invested, you can invest the money in the capital gain account scheme within a period of up to due date of ITR. Due date, not belated ITR. Here you have to be very visible. If money is not utilized, it will be taxed after 3 years from the date of transfer of the original asset, and you will be allowed to withdraw the money. Transfer of agricultural lands. 54B provides for transfer of agricultural lands. So individual RHF, where the land was used for the purposes of the agriculture by him or his parents, and later on that is transferred, then within 2 years you can purchase another agricultural land, rural or urban doesn't matter, you will get the deduction. The agricultural land may be short term, long term, doesn't matter, you can get the deduction. The issues are same, that suppose I purchase in the name of wife, it is allowed, but purchase in the name of son is not allowed. Joint name in the son, it is allowed. There are judgments to this effect in it. 54 bonds. You can invest 50 lakh rupees in 54 EC bonds provided the money is received from transfer of land or building or both. This deduction is in addition to 54, 54F or any other deduction. But amount of deduction is restricted to 50 lakhs. The bond cannot be converted into money by pledge or some other activity. Transfer of any asset, 54F. You transfer any asset other than a residential house and you acquire residential house. That is the mandate of section 54F. That is the mandate of section 54F. So what is the difference between 54 and 54F? In 54, you invest the capital gain. 54F, you invest the net consideration. 54, you sell the residential house, purchase another residential house. 54F, you sell any property other than residential house, acquire the residential house. In 54F, you invest net consideration, not the capital gain. Secondly, in the section 54F, you can have one house on the date of acquisition of new house, but after that you cannot acquire new house or purchase new house for 3 years. In 54, there is no such restriction. You purchase the house and you can purchase another house. Eligible individual RHF, वही 2 years before or 3 years after का इसमें रूल है. नेट कंसिडरेशन माइनस 10 करोड़ की लिमिट वो यहाँ पे भी लागू इन्होंने कर दी है. Important issue is in section 50C, would it come to the picture or not? Just a minute, I will take a small break, 5 minutes. So whether 50C value can be substituted for the 54 net consideration. The impact you have to understand. I have to invest in net consideration. So there is a capital gain, net consideration, and amount invested. Suppose that net consideration is substituted by the full 50C value, then my exemption will reduce because 50C value will be higher than the net consideration in general cases. The matter went to the tribunal level. Kanchand Batra and Prakash Karnawat, Raj Babbar. In all cases, Koli Madhevappa, it was held that you cannot expect a substitute here. And so there was not allowed any issue. But Jagdish C. Dabalia, Bombay High Court, has taken a contrary view and they have said that this way you are failing 50C, so 50C has to be pressed in service. And if it is higher than the net consideration, then 50C value will be substituted and you have to get deduction accordingly. SSC can be owner of a second property that will not affect his right to claim deduction under section 54F. Deposit in CGAS is the same. Investment in name of wife, first controversy was started from here only. Prakash versus ITO was the first case. And we have in 54F list of cases, battery of cases where investment in name of wife is does not be allowed. But in 54, we have a battery of cases where investment in name of wife is allowed. So it's a gray area. Better you invest in your name. CGAS impact, there are two types of deposits, saving account or FD. Legal heir can also comply and unutilized money will not be taxed in the hands of legal heir by virtue of circular number 743 dated 6/12/1996. ओपनिंग अकाउंट के लिए फॉर्म ए होना चाहिए, कन्वर्जन के लिए बी होना चाहिए, विड्रॉल के लिए सी होना चाहिए, यूटिलाइजेशन के लिए डी होना चाहिए। जनरली वो एओ का मांगते हैं, जरूरत नहीं है। एओ की अप्रूवल सिर्फ क्लोजिंग अकाउंट के समय ही होगी, अदरवाइज नहीं होगी। नाउ कंप्यूटेशन ऑफ टैक्स, वेरी इंपॉर्टेंट पार्ट। व्हाट हैपेंड? The government in the year Finance Act number 12 2024 has provided that there will be no indexation and reduced the rate of capital gains tax from 20% to 12.5%. Matter was raised before the government before passing of the budget that this way you are taking away my benefit because I have planned that way that when I sold the property I will get indexation and lesser tax will be there. So government grandfathered the provision and provided that, okay, you pay tax as per the old law, but for all other purposes, capital gain would be taken as the new law. This is the game beautifully played by the government, and they have taken more money from you than you would have saved. How? We will discuss. What they did, if property acquired before 21st 3rd July 2024, and it is transferred after that date, you can compute tax this way. First, you compute sales minus indexed cost into 20, sales minus cost into 12.5%. That is new regime. Then you compute sales minus indexed cost into 20%. That is old regime. If one is higher than two, then higher amount shall be ignored. So you have to pay tax up to 20% only. And if it is zero, yeah, if capital gain loss is there, nothing will be paid. Tax you have saved. But for all other purposes, capital gain would be under new method. So that will increase your slab rates. That will increase your surcharge rates. Because suppose you are having income of 90 lakh rupees and that capital gain amount comes to 50 lakh, your surcharge will go to that 15% slab. Loss will not be allowed because under the indexation there might have been loss. Here there will be no loss. And 54, you see, all investment has to be as per new method because at the time of allowing the deduction, I will allow only amount computed as per new method only because capital gain will be taken as new method only. So this way the government played very smartly, and in many cases people are paying more tax than earlier regime and at the same time suffering more problems. There was a widespread confusion on this issue again and again. So we have to be taken this topic along with the other issues, so that matter remains clear. Payment to non-residents, people are often confused. Non-residents, there is no 12.5%, 20%, it's only 12.5% without indexation, because it is for the benefit of resident individuals only. Rebates. There was a controversy that whether rebate is allowable or not. Suppose my total tax liability is 7 lakh, out of which 3 lakh is due to my income, normal income, and 4 lakh due to capital gain. The department is not allowing rebate on that 4 lakh. But term section 87A has been amended, and tax payable under normal provisions will only be rebatable. So 112, 111A, 12A, and 12, all tax will now be chargeable to tax. Now we come to TDS on transfer. Suppose you transfer a property, then the transferor then the person transferee would have to deduct, if you are a resident transferor, then transferee would have to deduct tax at the rate of 1% on the is the agreement value or stamp value, whichever is higher to be deducted. Rate of TDS is 1%, but he need not take any 10 number. If the amount of stamp value or agreement value or both doesn't exceed 50 lakh rupees per person, then there will be no deduction. Now issues arising. Suppose Mr. B transfer property, consideration for transfer is 49 lakhs. Stamp value 50 lakh, 52 lakhs, tax will be deducted on 52 lakhs. Suppose there are two sellers. In that situation also, tax will be deducted because stamp value is acquire the property, not the acquire the seller. While consideration may be acquire the seller 24 lakh each, stamp value is acquire the property, so you have to deduct tax. Legislative wish is there. There is a 10% band in 50C and 43CA. Now suppose you transfer a property for 1 crore rupees. Stamp duty value comes to 1.5 lakh rupees. You will deduct tax on 1.5 lakh rupees. But for capital gains, you will report 1 crore rupees as the consideration. Mismatch issues will arise and CPC will not understand, and you have to pay the price. So these are the important issues. Some of the illustrations which we need to be done. Tax purchase and 41 rupees, stamp duty value 55 lakh rupees, 55 lakh rupees पे stamp value दी है, and 55 lakh rupees will be the amount for TDS, and the difference 10 lakhs will be taxed under section 56(2)(10) because you are purchasing the property for a value less than the stamp value. Suppose you enter into 55 lakhs by paying 1 lakh token money, and balance consideration is paid after some time, still tax will be deducted on entire amount of 55 lakhs. Tax deduction account number is not important. Compensation TDS. Any compensation, enhanced compensation, another deduction under section. Right to fair compensation वाला यहाँ पे formula लग जाएगा. This brings up us to end of the first part of the seminar, that is immovable property. If we can take up queries to this part here or here, it would be better. If somebody is listening, please come on screen.
Yes, sir.
Yeah. No query?
Sir, just a moment. Sir, we have a lot of queries.
Oh.
First one is, Treatment of compensation received from builders.
Compensation received from builders for the shifting of the property rental compensation, I think he is talking. It is treated as a capital asset. There are recent case laws on it. If required, you just send me WhatsApp. Hi, I will share the relevant case with you. Or
Okay.
I will send it to you. You can circulate it among members.
Not an issue, sir. Tax liability of landowner A. Income tax. B. GST on his portion of flats if he sells them or if he does not sell them. How to remove mortgage from municipalities by landlord.
These are the part of the land development agreement. I think we will discuss it in the second session, second part of the session. Okay. Next.
What are the tax treatment and revenue recognition in case of JDA in real estate transaction?
We are coming to that only.
Okay. Uh, what is the alternative method of taxation in case the assessee breaches the condition laid down by section 45(5)(a) of Income Tax Act?
We are coming to that.
Okay. Interest on loan taken for acquiring a property can be capitalized of previous year.
Yeah, no problem.
Please advise on the taxation of redevelopment of housing society. अच्छा ठीक है.
We will take up.
Yeah. Next is I am representing a case in CIT appeals. In this case, I have asked the CIT to consider the superstructure value by retained land is the value of foregone land. Is it correct?
And we are coming to that part only.
Okay, sir. So the next is details of computation. Composite market value as per SRO is 2,500. Present possession of constructed area received, which is 44,515 square feet.
Okay.
Rupees 25.
This is part of LDA. Next.
Okay. Sale agreement with full payment with corresponding TDS coupled with possession of property is in parlance your views.
No. Sale agreement must be registered or either sale deed must be registered.
Okay, sir. Next is regarding the book on income tax. अच्छा, ये तो irrelevant.
Okay, then we move to land development agreement.
Yeah.
Land development agreement was a very gray area. It started in 2004 or something. Then first judgment, Vasavi Pratap Chand of Mumbai bench of ITFT was delivered. This was the first judgment on the issue of land development agreements. Prior to that, there was no such land development agreements. So in that case, the SSC parted with 56% of the undivided share in the land for 44% of the constructed area and issues as to taxation has arose. Suppose you transfer the land, there is no problem. You compute capital gain as per normal method. But you give the land for development, the developer incurs money on it, and you get constructed area 44% for 56%. Then there are taxation issues arise. In Finance Act 2017, the government tries to streamline these issues with the introduction of subsection 5A in section 45. What they did, that in the case of an individual or HUF, if they transfer a capital asset and that capital asset is given for development to a developer under a specified agreement, which is registered, then in consideration of a share in the constructed area plus cash or check component, then chargeability would be the date when completion certificate for whole or part of the project is issued by a competent authority. Stamp duty value on that date will be taken of that part plus cash component and minus cost will be the taxable amount. This is 45(5)(a) for individual HF only. So there are issues in it. Asset transfer must be capital asset. It cannot be stock in trade or anything else. A specified agreement must be registered and that specified agreement has to be And SSC must receive constructed part, not only money and all that. Suppose the SSC enters an agreement with the developer that you pay me the upfront money, suppose 5 crore rupees, and then after construction is over, you sell the constructed area and give me 30% of it. 45(5)(a) will not apply because you are not receiving the constructed area. You have to receive the constructed area and sell it yourself. The first question which was recently asked is that in such situation, value of that constructed area is stamp value and tax will be paid on it. And later on, when you sell that flat, that stamp value would be the cost and difference will be taxed again as capital gain, short term or long term, depending upon the period of holding. Provisions of 45(5)(a) shall not apply where the SSC transfer is share in the project before the date of issue of completion certificate. Specified registered agreement. Real estate project is not defined in section and income tax act. You have to depend upon the real definition for it. Cost of acquisition will be the fair value taxed in the hands of the subsequent transfer. That cost will be. Whether 45 will be retrospective? No. 1/4/2018 के बाद जो agreement है उन पर लागू होगा. Whether it applies to non-residents? Yes, because there must be an SSC individual ownership, not resident or non-resident. Nature of asset does not matter. It can be short-term or long-term capital asset. Part completion certificate. It may happen the competent authority issues a certificate for a part of the project. Then in that situation, two questions arise. First, whether the entire amount will be taxed now or only that part. In our opinion, for that part, stamp value would be taken. For that part, cash component percentage may be taken out, and that amount will be taxed in the year of issue of capital certificate. For rest part, whenever completion certificate is issued, again same exercise will be done and capital gains will be computed accordingly. Exemptions. You require that money when to be invested. 45(2) defers the capital gains in a similar fashion in 45(5)(a) defers. You transfer the property today, but capital gains is taxed in the year of completion certificate. So 6 months period will be counted from the year of completion certificate. This is the mandate of circular number 791. Premature transfer. Before issue of completion certificate, you should transfer your share. What will happen? 45(5)(a) will go. Computation will be as per normal provisions of the Act, but in the year in which that you transfer, not in the year that original transfer took place. Number two, what is the mandate of this provision? Suppose I transfer a part of the project. Suppose I transfer a part of the shared area. Suppose I transfer full part. The mandate is you transfer a part of it, you are out of 45(5)(a), because if the intention was to keep 45(5)(a) alive, then that intention may be defeated because SSC may transfer 90% of the his share and balance 10% may be transferred on the issue of completion certificate, and this way you can circumvent provision to section 45(5)(a). To stop this practice, they have given part of the project is also gone. Now here comes the issue of full value of consideration. Because what will be the full value of consideration? Law is silent on it. In such a situation, you can either go to section 50 capital D for determination of the fair value, or you can apply your own method of stamp value or something else. Otherwise, things will be in a different. Can the entire consideration be in cash? No. it is not possible. Fractional ownership, yes, it is allowed. Developer constitution, LLP है, firm है, company, nothing matters. I can go to any developer. Entire constitution is 45(5)(a) will fail. Constructed area. If you receive constructed area, there are judgments. Vasavi Pratap Chand, NS Nagaraj, and all that we have discussed. Completion certificate part of the project we have discussed. Exemption of 54 we have discussed. Deposit in capital gain account scheme. There is nothing mandated in section itself, so there will be issues in such a situation. Premature sale we have already discussed what is going to happen. Revenue sharing arrangement we will discuss that only revenue you take. No, 45(5) will not apply. Agar if a landowner converts his land in stock and trade before going for development, capital asset is not there, so 45(5) will be out. Challenge to stamp value 45(5) doesn't provide, 50C provides. So you have to import 50C into 45(5)(a) and challenge accordingly. Provisions of 45(5) when does not apply, and the owner is other than individual or HUF. Entire consideration is received in cash or in check or a percentage of revenue generated. Land or building or both are transferred to the project are not liable to, are not capital asset. Specified agreement registered ही नहीं है. SSC transfer is shared in project or before date of issue of complex certificate 45(5)(a) will not apply. What is date of transfer? The act is silent, but it is generally the date of issue of completion certificate. Cost of movement generally does not there. If it is there, the person paying developer will deduct tax at the rate of 10% from the money paying to you, but not the consideration in shared agreement, because shared value he can find. Now we come to normal JDAs. Suppose that JDA is out, 45(a) is not applicable. So you tie up with the developer, you give your land in lieu of shared area, constructed area, revenue sharing arrangements are there. There are different arrangements, and each arrangement we will discuss now. First arrangement is registration. That agreement has to be registered, otherwise everything fails. Developer selling the project and floor area. Constructed area. So constructed area, suppose 50% I have given. Till now, what we were doing is that the cost of construction of that 50% area is taken as full value of consideration and tax is paid. And later on, when transferred that constructed area, that 50% is my cost and that will. But recently, some 2-3 High Court judgments have said that cost of construction is not a criteria to determine the value of the constructed area. So again, development agreement drafting has to be very carefully be done. In some cases, the development agreement itself recited that constructed area will be valued as per 11,000 per square feet. In that situation, court has accepted that 11,000 per square feet is the value of consideration. No problem in it. Otherwise, court have said you have to find some way to determine the cost of construction. So that is the issue which we are still facing. In general, JDA is not covered by section 45(5)(a). When transfer happens, there are battery of judgments on it, Chajbir Singh, Sakseria, Vikas Bahel, Chaturvedi. It all depends upon your development agreement. In Chaturvedi's case, he has given entire land to the developer. The transfer happened then and there. Today, the methodology is the developer is given a license to enter upon the property and he is only developing the property. So transfer happened when he hands over constructed area to me. This is the recent practice. So how you draft your development agreement, what is recited in the development agreement is the point that will be taken in any situation. And we have to be very careful in handling such cases, in advising on such issues, and you have to charge your fees accordingly. Please, charging of fees is very much important. Don't look upon the client, and we will always be saying, I am getting nothing, and he has the money. He is the master of mastering, he has the mastered the art of betraying us. एंड ही नोज दैट ये साहब जो है वो पिघल जाएंगे और बोलेंगे अभी तो पैसा ही नहीं मिला, अभी तो प्रॉपर्टी दी है, पता नहीं क्या डेवलप करेगा, डेवलपर बदमाशी कर रहा है। भैया बदमाशी कर रहा है, कुछ भी कर रहा है, मेरा पैसा मुझे मिलेगा, देन आई विल एडवाइज, अदरवाइज आई विल नॉट एडवाइज। सीधी सी बात ये है, ये हमको सबको दिस प्रैक्टिस वी हैव टू अडॉप्ट ऑल द पर्सन, अदरवाइज पीपल विल टेक जूस आउट ऑफ अस and nothing will come to us. Suppose you give a general power of attorney along with the possession and agreement is registered, transfer happens then and there. Only license can save you. Developer must be willing to perform, otherwise transfer doesn't happen. Written agreement नहीं है, transfer नहीं होगा. Land handed over कर दिया, transfer हो गया. Permissive possession दिया only to construct the property, transfer नहीं हुआ till property is constructed. Possession in either development agreement execute किया, nothing transfer, कुछ आया ही नहीं. डॉक्यूमेंट के थ्रू ट्रांसफर कर चेंज ला खलना गया. पोजीशन handed over, unregistered JDA की अब कोई वैल्यू नहीं, there is no value of unregistered JDA because of the Balwezi money case. TK Dayalu, they have given the entire property to him under the control of the developer, transfer happened then and there. Only licensee Atam Prakash instance, transfer doesn't happen because he is a licensee, not the owner. So how you draft, how you handle your development agreement is the key to taxation of that development agreement. 53 conditions not satisfied, again no issues. Now we come to the revenue sharing. A little bit of disturbance. Business income. Suppose I also try to do business. I convert the land into stock and trade. Then I have to pass the necessary entries in the books of accounts. We have to convert the asset into stock and trade. And 45(2) will apply. And then you sell, then it is business income. In one cases, the SSC claimed there is a transfer, but no entries were passed as Raja Kumar Bangalore Tribunal. Tribunal said no, it is not a business income. Constructed area period of holding, obviously the day I get it to the date I sell is the period of holding the construction area. Share in the constructed area, same thing. No consideration. Stock and trade we have discussed. Accrual capital position not given. Sadia Sheikh के केस में PO दे दिया, ट्रांसफर हो गया. 45(2) पहले वो 45(2) में टैक्स हो गया, फिर इधर हो गया. Conversion कब होगा? When you pass necessary entries in your books of accounts. That is more important. Later sale of flats, the value already taxed. Only license है तो हम डिस्कस कर चुके हैं. 45(2) हम डिस्कस कर चुके हैं. 53 not satisfied. Demolition of building, nothing important. Stock and trade we have discussed. Some slides are duplicate and sometimes it happens because you cannot remember all the slides all the time. So don't think I am passing or I am doing anything, but we have discussed the issues, so I am not repeating those issues. I am finding that one more important point. Fair value of the constructed area, exchange value. Suppose in the development agreement you have already decided, we have discussed this issue, then that value will be the fair value, and on that value you will be paying taxes. If it is more than stamp duty value, no problem would arise and you are in the safer zone. this is the fair value of constructed area concept. Redevelopment of societies. What you are giving is the old house getting new house. तो ओल्ड हाउस की कॉस्ट न्यू हाउस की वैल्यूएशन जो आएगी वट एवर स्टाम्प ड्यूटी वैल्यू द डिफरेंस इज टैक्स दैट इज द सिंपल रीडेवलपमेंट कंसेप्ट TDR, earlier it was held that they are exempt because they have zero cost. Now section 55 has been amended and there they have written a word that any asset of which cost is not determinable, it is zero, it will be taken as zero. So now TDR entire amount is chargeable to tax after Finance Act 2023. Similarly for FSI, you have to pay tax on the entire amount because of that amendment. This is my presentation of today. I was not expecting I will deliver entire lecture, but it has happened in 1 hour only. Thank you. Thank you, committee, and thank you, members, for listening. Now we can take up the rest of the queries if it is there. Hello. Ritu madam?
Sir,
Yeah.
just a second, sir. I am just somehow my video is not getting started. Yeah. So, sir, we have some queries. When is the landowner pay tax when he has given his land for development of flats, received an amount, advance amount?
So depends upon the recitals in the agreement and position given on agreement is registered or not. So if agreement is not registered, then nothing will be taxable. But if agreement is registered and position is given, the first tax, capital gains tax will arise then and there. And second will when you receive the flats and you sold those flats, then second capital gain would arise.
Okay. The next is, if a company purchases a property for a value higher than the registered sale deed value, what is the impact of the higher amount paid by the buyer or the higher amount received by the seller? All payments as per sale agreement and through bank account, please clarify.
Nothing, no problem in it. If it is higher than the stamp value, then still no problem. You have to pay capital gains tax on that value which you have received, not the stamp value.
Transaction on movable property applicability limit and cost of construction.
Applicability of?
Applicability, exactly. Applicable limits and cost of construction. ऐसा लिखा है sir.
Cost of construction you have to determine as per your bills, etc. And if developer is there, you have to take a certificate that the cost of construction is that, so that it can be admitted later on.
So the next is sale agreement records actual agreed price, but sale deed is registered for the value as per the guideline value. What is the impact on the seller and on the buyer?
You have to destroy the sale agreement. That is all we can say in the camera.
In case of sale of flat by non-resident foreign citizen, what will be TDS to be deducted by buyer if the flat guidance value is say rupees 100, whereas consideration is only rupees 40? Sale value due to very old flat. 50C is applicable in this case.
Yeah,
Whether
50 is applicable and section 195 will come into play and tax will be deducted according to 195, not 194 IA.
Okay. So the next query is the sale of land made in financial year 17-18 for rupees 60 lakhs, which was purchased in financial year 2011-12 for 20 lakhs. Sale agreement also made in financial year 17-18. The assessee paid the capital gain tax in financial year 17-18. The transferee could not register the land in his name and sale agreement got cancelled in 24-25. The sale consideration was returned, which was paid in financial year 17-18. Now for assessee, what is the date of acquisition and cost of acquisition?
Date of acquisition is 2011, cost of acquisition is 2011, but problem will arise after now because you will be paying tax on the stamp value of today.
Okay, sir. So the next is if long-term mutual funds sold in November 25, one residential flat allotted in 2018 under payments made in installments on construction linked basis. If the flat is registered or possession taken in October 25 or January 26, whether capital gain on sale of bonds will be covered under 54F.
Yeah, you can cover because purchase can happen up to 2 years, but construction can happen up to 3 years from the date of transfer.
Okay. Do we need to report in ITR after 3 years or whatever we utilize the funds which we earlier deposited in capital gain account scheme?
Yeah, there is a special column in now ITR. You have to report.
Okay, sir. Individual transfer his land to company and company then sell the land. Tax treatment in this case.
Then in the hands of individual, stamp duty value minus cost will be the tax, and company will be paying on the stamp duty value as its cost, and again they will be paying tax.
Just a second, sir. What should be the value of building in society balance sheet after redevelopment?
Building key value in society, it will be the cost of construction incurred by the society or builder.
Okay, sir. Sale of flats before is OC by landowner. What is the taxability and year?
Pardon?
Such sale of flats for before OC by landowner. What is the taxability and year?
Year will be the in which before you have sold the flats, and taxability will be as per normal provisions. 45(5)(a) will not apply.
What shall be the treatment in case the landowner is getting back multiple flats? Can exemption for 54 and 54F be claimed for all flats if all are registered in the name of landowner via one deed?
No, only 1 or 2 flats. That's all.
Okay, sir. Last two queries, sir. In case where assessee has to hand over the flat on account of redevelopment project and will receive a new flat in future, is this covered in JDA also?
Pardon again?
In case where assessee has to hand over the flat on account of redevelopment project and will receive a new flat in future, is this covered in JDA also?
No, it is not JDA, it is redevelopment simpliciter, nothing. SSC is not entered to JDA. JDA is entered by the cooperative society, which is holding the owner of these flats.
Whether section 194 IA will be applicable for society redevelopment case where one get new flat in exchange of old.
Yeah, no, but yes, it will be applying.
Will indexation benefit be available for properties acquired before 23rd July 2024?
Only for tax computation purposes, not for capital gain computation purpose.
Okay, sir. I think, sir, almost all the queries got answers today. Thank you so much, sir, for this wonderful session.
If it still remains some queries, one can WhatsApp me on the number given in that presentation. No problem.
Yeah, and many members are asking for the recording. So I would like to tell members that this recording will be available on ICI TV in a day or two. So you can watch anytime and take maximum benefit of this webinar. Apart from this, we will try to share the PPT. And since the recording is available, you can always refer the PPT in recording itself.
Okay.
With this, I would like to thank you, sir, on behalf of DTC committee. And I would like to thank DTC committee for giving me this opportunity. Thank you so much.
Thank you.